Well, good morning, everyone. Thank you for joining us. I'm Alex Scanlon, CEO of Barton Gold. And before we get into our presentation, the image here is useful for reference. It's a shallow open pit that we have at our Tarcoola project. So, theory of Barton Gold, who are we? What do we do? Why do we do it? Why do we care? We are a pure play gold, pure play South Australian developer. And South Australia is very interesting as a state when it comes to gold. It contains about 25% of all of Australia's known gold resources, but speaks for only about 2.5% of annual production, which is quite a disparity. And that really speaks to a pronounced legacy of investment in copper and, to a lesser extent, uranium development. The central Gawler Craton is the home of Olympic Dam, which is, of course, globally renowned. And Carapatina and Prominent Hill as well have also been developed there. And that IOCG province sits to the east of a gold province where the same mineralizing basin comes up and goes from being sort of deep and coppery to shallow and goldy. And we sort of sought an opportunity to essentially consolidate that district. We acquired the majority of the historical exploration and production assets in the area. We acquired the only gold mill in the area. And the strategy has been to step back and build a much larger, much stronger geological understanding of what's happening in certain of these structures and systems, and then turn this back on to, in sort of a staged, progressive fashion with lower risk and lower cost to target a much larger productive output. So our strategy has been first to establish really large-scale baseload mineralization, two, to then come back and put some higher grade mineralization in and around that, and then three, to leverage our existing infrastructure being that mill. So we've been making a great amount of progress in doing that over the past few years. We've just had 3 resource upgrades over the past 12 months. We have now moved our large-scale baseload project, Tunkillia, into scoping studies. And we've now started drilling a neighboring high-grade, or a field of high-grade targets based around an historical high-grade mining district. We're very well capitalized to continue doing this, and we think the rest of the year is going to be very exciting. We have had quite a bit of progress over the past 18 months in particular, as we've sort of systematically identified and converted new mineralization into new resources and growth. So what we've really seen is a very strong consolidation of our register, in a matter of speaking, around strong board and management alignment, really consistent performance and progress with our story and our project, sort of doing what we say we're going to do. And we've had very, very strong endorsement from a number of institutional investors who've joined us in a few small rounds of financing. And that has now seen or translated, in particular with maybe a thawing sort of energy in the gold equities market, into a large inflow of new retail investors who all buy our shares on market. So we've done quite well relative to the gold price, relative to VanEck Producers Index. But that really comes down to, I think, really consistent progress performance in a team that's quite serious about doing what we said we're going to do. When we think about the capital structure of the company, the human capital cannot be overlooked or understated. We really start with the premise of people first when we buy assets or when we have invested traditionally as investors. So we've built a team that really has the capability and breadth of experience necessary to do what we want to do. And so we've got, just in our senior leadership team, well over 200 years of experience exploring for permitting, financing, building, operating, and optimizing major mining assets with a particularly strong pedigree both in gold and in South Australia. So today, everybody will be very aware in the modern context of Newmont buying Newcrest. 22 years ago, Newmont bought Normandy Mining, which was the largest gold producer in the Southern Hemisphere. It was the Australian gold company. About half of my team are formerly of Normandy and Newmont, so we're sort of getting some of the gang back together. But this team has a breadth of experience, which we really need to be more than just an explorer, but actually become a developer and meet our objective. And that objective is to turn these assets into a significant gold producer targeting around 150,000 ounces per annum of production. So what are we looking at here? What's our strategy to do that? We have a collection of assets that sit in the central Gawler Gold Province. And what we're targeting really here is large-scale open pit mineralization. We like open pit mineralization because it is faster, easier, cheaper, and safer to explore for, develop, and operate than working in an underground environment. We have sort of 3 steps to our strategy to go from, let's say, zero to hero, if you will. One is to establish a long-term asset, right? So we have focused on establishing bulk, large-scale, open-pittable mineralization that can give us a 10-year life as a company, make us a real company, and then come back around and focus on higher grade enhancements in the vicinity of that project for two reasons. One, high grade enhancements in a neighboring field could also act as blending feed to that large scale project, but they can also be processed through our existing mill. So when we look at the ground that we're primarily interested in here, we're looking at our Tarcoola and our Tunkillia projects there, sort of in the bottom of our project area. And these are two projects that are together about 3,000 square kilometers worth of ground. We have over 100 kilometers of major structures on this ground. And on all these structures, in less than 2% of them, we've now built up a 1.5 million ounce resource base. So we're confident we're on the right track there. Tarcoola and Tunkillia will in the future be operating in tandem as a single project. They're 70 kilometers apart from one another. So from a modern logistical standpoint, they are one project. But we have this very unique advantage of being able to split them apart because Tunkillia is that large-scale baseload project that we're talking about. Tarcoola is the historical high-grade gold field there. As we move forward and map out high-grade mineralization at Tarcoola, yes, indeed, it can be trucked down to a new future mill at Tunkillia for big, bulk, high-efficiency operations and hopefully high-profit production. But we can also take mineralization from Tarcoola and put it through our mill where it was processed in 2017 and 2018 with very strong recoveries. So when we think about a sort of stage one strategy here, we have proven logistics, proven infrastructure, proven metallurgy. That allows us to look at going from 0 to 150,000 ounces per annum in a staged, lower cost and lower risk basis, leveraging our third point of strategy, our existing infrastructure. So it is much more favorable to us in all respects, both from a risk and a financial standpoint, to go from 0 to 25 to 50,000 ounces per annum and then use that to fund internally our expansion to 150,000 ounces per annum, at which time we would own the only two gold mills in the entire gold district. Now, why focus on the big bulk open pit as our primary strategy? One, it's good to have something that's sort of a flagship asset that has real duration to it. But two, if you want to underwrite the economics of a real company, you've got to do it with an asset that has the ability to generate significant profits, right? So it's not just big, but it actually has the ability to sort of finance you and your expansion elsewhere. Bulk open pit mining works better than anything everywhere all the time, bar none, right? If you can mine gold the way that you mine coal, that is how you should mine gold, right? So volumetric efficiencies of capital and operating costs are how you make low unit costs, and that is how you make high profits. It's a fairly simple equation. We profile Capricorn Metals as an example of this. In Australia, we tend to think of ourselves as a high-grade underground gold mining district. And generally in Australia, we are. A lot of open pit mines were mined out in the 80s and 90s, and everybody went underground. But we do have really good examples, even in the Australian setting, of why bulk open pit is better. Capricorn Metals is a name that probably many of you will know. This is a group that acquired a project called Karlawinda in 2015 as a 650,000 ounce asset. They grew it to 900,000 ounces and 1.1 and 1.3 and 1.5 million ounces. And then they focused on building this as a bulk open pit operation. And they've since scaled it further. Today, it's about a 2.2 million ounce asset at around 0.7 gram per ton. So what we might conventionally think of as low grade within an Australian context. However, that is today operating with a mill that's processing between 4 and 4.5 million ton per annum. They are producing 120,000 ounces per annum, and they are doing that consistently at an all-in sustaining cost of around 1,300 to 1,500 Australian dollars per ounce, or about 850 US to 1,000 US. So they are regularly on a quarter-by-quarter basis the lowest cost or one of the lowest cost gold producers in Australia. That's very instructive. And when we looked at our Tunkillia asset, we saw in the raw data many of the hallmarks of what we saw when we were looking at Karlawinda as investors several years before. We acquired Tunkillia in the end of 2019, early 2020. That was a 550,000 ounce asset at the time. We then grew it to 900,000 ounces. We found 5 new gold zones, and we grew it to 1.1 and 1.3 and 1.5 million ounces. So we are following almost precisely the progression of the party that we would call the leaders in this field in Australia. And we have now moved Tunkillia into scoping studies to take it into that development track. So when we look at Tunkillia here, when you look at the map, what you see here as a project footprint, there's a very linear progression of mineralization. That is the western margin of a very large shear zone that has historically been very underexplored, and at a time when the gold price was on average very, very low. The footprint that we acquired, in a matter of speaking, is that sort of central darker blue area. The first thing we did was drill a central area there that we were fairly convinced had a pretty reliable higher grade central zone. We validated that. We then extended it to depth twice to make it a sort of bulk open pittable shape in terms of a pit floor. And then we mapped out 5 new gold zones along strike and on the other side of the shear zone. So that area 191 target where you've got sort of a series of high grade intercepts is actually the eastern margin of that shear zone. So a very different geology, we think, there. But we sort of progressively built this up. We've done it very cheaply. Our cost of resource growth has been $15 per ounce Australian on an all-in basis. That's not a drilling cost. That is drilling and assaying and labor and logistics and absolutely everything. So about 20% of the normal Australian average cost of developing ounces is our growth rate in Tunkillia. This asset has now moved into scoping studies. We expect to have that out by the end of June or early July. And what we're looking at here is really just the start. We have another 20 kilometers of untested shear zone here. When we think about the scoping study, what we're targeting here, again, we're looking for big bulk open pit mineralization. The mineralization at Tunkillia extends beyond 400 meters depth, but we constrain our resource modeling and thinking about an open pit to 300 meters. So we're not interested in drilling 500 meter deep drill holes for 1 gram mineralization. We cut it off at 300 meters depth. We want a big bulk efficient open pit, and we're much more interested in finding the next big thing along strike than we are going deeper and deeper, because once you're mining this, you can just keep going deeper anyway. The geometry of the geology is starting to look very interesting here. We have sort of 3 key features to think about when we look at this project. One is that while we constrained our resources to about 300 meters depth, about 80% of those resources are within 200 meters of surface. So there's a bias to shallow within that 300 meter pit. There is also, right in the center of the deposit, where it is also the thickest, a 300 meter long higher grade zone of mineralization. And that's that cross section you see on the right. So what that does is it means we've got a body of mineralization in the fresh ore zone that is 80 to 100 meters wide. So this is a football field long wide in terms of your mining face on the pit floor. That is the biggest, bulkiest way you're going to get to mine gold. And within that, you have 20 to 30 meters of higher grade mineralization. So we also have a bias to the central zone of this deposit, a perfect place to put a starter pit. And then we have this supergene sequence, which is the T-zone you see in the cross-section. And as we open the pit to the north and the south, we're actually mining and producing 250,000 ounces. So our pre-strip starts to pay us instead of us paying the pre-strip. So we think that's very interesting. And we will have the first economics out on this hopefully in the next month or two. Everything that we've looked at there at Tunkillia is really just in that little green box there. So we have another 20 kilometers of a major shear zone that remains untested. We do think that this could turn into a much larger district in due course. And if you did have a district of bulk open pit mines, you would love to have some high grade blending feed nearby. That's where we step back 70 kilometers to the north to Tarcoola. This is the home of high grade gold in South Australia. There are a series of structures that outcrop over a small area of escarpment, and across this area there are about 600 historical workings where the old timers were producing gold at 30, 40, and 50 grams per ton. Fast forward 100 years, and a small mining lease was put in place, and a small pit was open around one of these historical shafts, and that produced somewhere around 30,000 ounces at 3 to 4 grams per ton of sort of a bulk grade to our mill. The question for us, though, is what is happening underneath that ground there, under the balance of cover that created all this mineralization, and what remains untouched. When we look at the pit itself, it's quite instructive in terms of the type of value that you can get out of a little hole like this. The pit's only about 450 to 500 meters long. It's shallow, 60 meters deep at its deepest point. But that pit produced a great deal of value. There is high-grade gold intercepts all around it, beneath it, and along strike. But where it gets really interesting is this picture. So we spent 2.5 years building this regional geological model in parallel with building Tunkillia to 1.5 million ounces. What this is a 3D structural model of the architectural structure underneath that gold field. And this is the first time in 130 years that you can put all of the known historical gold occurrences in a consistent structural framework. Yesterday or the day before, we just started drilling 7 targets across this. So we're looking to fill in a field of high-grade mineralization here that can blend into Tunkillia, but actually act as a stage 1 operation, use our existing mill. So it's been a very, very busy year for us for the year past. We've had 3 resource upgrades. We expect to have 1 or 2 more during the balance of the year. We have sold gold. We will continue to sell gold. We will have scoping studies out. And we think this is coming together at a perfect time for us in a market that's just starting to get a little bit more interested in gold investment during 2024. So thank you very much.